Welcome viewers in continuation of series of IFRS 9. Today our topic is recognition of financial instruments. My name is Muhammad Shakeel and we are recording this lecture at the platform of Hope House of Professional Education. This IFRS is applicable on single as well as consolidated financial statements. Hence, an entity first consolidate all subsidies in accordance with IFRS 10 and then applies this IFRS. If you are having any query regarding these lectures, please feel free to contact us on the given mailing address. There are two ways for recognition of financial instruments. Number one is the contract. An entity shall recognize financial assets or financial liabilities in its statements of financial positions when and only when the entity becomes party of the contractual provisions of the instruments. An initial recognition of financial instruments is measured at fair value including transaction costs unless the financial instrument is carried at fair value through profit and loss account, in which case the transaction costs are immediately recognized in profit and loss. The fair value is determined in accordance with IFRS 13 fair value measurement. Let's consider one example where we are recognizing fair value changes due to change in own credit risk. Entity A issued a bond under conditions that qualify for the fair value options in IFRS 9 and decided to designate the liability to be accounted for at fair value through profit and loss account. At the end of the financial reporting period, entity A determined that $2 of the change in the fair value of the bond of $10 is due to a change in entity A's credit risk required. How should entity A account for the fair value change? Now we can see that the total change in the fair value of the bond is $10, out of which $2 is due to entity A's credit risk. So the accounting entry will be, we will debit the financial liability for bonds by $10 and we will credit the OCI other comprehensive with $2 and the balance $8 will be transferred to profit and loss account. Now see the other way which we can recognize the financial instruments, that is the regular purchase or sale of financial instruments should be recognized during regular sale or purchase based on the market trend. A regular way purchase or sale of financial assets shall be recognized as applicable using the TD. Accounting means transfer of asset at the time of contract. The trade date or TD is the date that an entity commits itself to purchase or sell an asset, or the other way is the settlement date. Settlement date accounting means actual delivery date. The settlement date is the date that an asset delivered to or by an entity. Now we will discuss in detail regular purchase or sale. Under purchase of a financial assets, we will be either at trade date or at settlement date. Under both the cases, the difference will be charged to profit and loss account or OCI as the case may be. In case of sale, either through TD or settlement date, in both the cases the profit will be charged to profit and loss account only. If the value of financial instrument change between contract date and settlement date, this change having no effect on fair value of financial instruments. Let's go through some examples for better understanding of this concept. Number one, how are the trade date and settlement date accounting principles of IFRS 9 applies to a purchase of a financial asset. On 25th December 20x1, an entity commits itself to purchase a financial assets for $1,000, which it is fair value on commitment date. Transaction costs are immaterial on 31st December 20x1 financial year end and on the 4th January 20x2 settlement date, the fair value of the assets is $1002 and $1003 respectively. The amount to be recorded for asset will depend on how it is classified and whether TD or settlement date accounting is used. Let's see the accounting fact if the asset is purchased at settlement date. In this case, at the end of the year December 31st x1, the difference of fair value and financial asset amounting to $2 will be recorded under account receivables, and other effect will be passed on to profit or loss or OCI as the case may be. And on settlement date, the financial assets will be recorded by $1003, and the difference in fair value, i.e. $3, will be recorded via P&L or OCI as the case may be. But if we are recording our fixed financial instruments based on amortization cost method, then financial assets will be recorded by $1000. On the other hand, if we are recording the financial assets purchased through TD dates, then what happened? In this case, we will record financial asset and financial liability as on 31st December x1 with $1000, and any change in financial value, any change in fair value of financial assets will be debited to financial assets and credited to P&L or OCI as the case may be, except in case of amortization cost accounting, where we will ignore the effect of the increase in fair value. Now consider the other example. How are the trade date or settlement date accounting principles in IFRS 9 applied to a sale of a financial asset? On 31st December 20x2, TD, an entity, enters into a contract to sell a financial asset for its current fair value of 1010. The asset was acquired 1 year earlier for 1000, and its gross carrying amount is also 1000 on 31st December 20x2. The fair value of the asset is 1012 on 4th January. The settlement date, the fair value is 1030. The amount to be recorded will depend on how the asset is classified and whether trade debt or settlement date accounting is used. Any loss allowance or interest revenue on the financial assets is discharged for the purpose of this example. Let's see the solutions. And the accounting fact if the asset is sale on settlement date. In this case, at the end of the year 31st December x2, the difference of fair value and financial asset amounting to $10 will be recorded under financial assets, and the other fact will be passed on to P&L or OCI as the case may be. And the settlement date, the receivable will be recorded by 1010, and the difference of fair value I10 will be recorded by retained earnings through P&L. But if we are recording our FA financial asset based on amortization cost rather than the change of fair value will be ignored. On the other hand, if we are recording FA sale through trade debt base, then we will record receivables with 1010, and change in fair value amounting $10 will be recorded as profit through retained earning through profit and loss account. So viewers, this is all about regarding this topic. If you are having some better suggestions, please share with us so that we will be able to consider your valuable suggestions while recording our future lectures. Thank you.